You ever stop and think about the cash in your wallet? Like, what actually makes it valuable? For a really long time, the answer was super simple: gold. So today, we're going to decode the whole dramatic story of the gold standard, why we had it, why we ditched it, and why we just can't seem to let go of this shiny metal. All right, let's get into it. It really all boils down to this one huge question. Is money worth something because it's made of something precious? Or is it just, valuable because we all say it is? Believe it or not, that single question has shaped like centuries of economic history. So those two different answers give us two totally different kinds of money. On one hand, you've got commodity money. Think of a gold coin. It's valuable because it's made of gold. But on the other hand, you've got fiat money. That's like the dollar you have today. It only has value because the government declares it does. And crucially, we all trust that they're right.
All right, so to try and settle this whole debate once and for all, more than 100 years ago, the US made a huge call. They decided to tie their currency to something real, something tangible that everyone agreed was valuable. And yeah, you guessed it, they chose gold.
See, back then, the American economy was kind of like the Wild West. It was all over the place. If the country was going to become this big, modern, industrial powerhouse, it desperately needed one single, trustworthy currency, something a banker in New York and a farmer in California could both believe in. The solution? Make the US dollar literally as good as gold. And so, it happened. In 1900, President William McKinley signed the Gold Standard Act into law. Now, this wasn't just some pinky promise. This was the real deal, written right into federal law. It was an official guarantee that every US dollar was defined by and could be swapped for a very specific amount of gold. And this right here, this was the magic number. The law locked in the price of 1 troy ounce of gold. That's just the standard way they weigh precious metals, at exactly $20.67. So every single paper dollar in circulation was basically a claim check for a tiny little sliver of the government's gold. It made the whole thing feel incredibly real. Okay, so what was it actually like? Living in an economy that was tied directly to a chunk of metal. Let's take a look at the gold standard era in action. Right, so the thing is, this 1900 Act didn't just come out of nowhere. It was actually the finish line of a really long race. The whole process started decades before, first by kind of pushing silver out of the picture, and then by letting people trade in their paper money for actual gold. The law in 1900 just, sealed the deal.
Now, the biggest selling point for the gold standard, the whole reason for doing it, was this promise of keeping prices stable for the long haul. I mean, think about it. There's only so much gold in the world, right? So the government couldn't just fire up the printing presses whenever it felt like it. This was supposed to be the ultimate check on power, preventing crazy inflation and protecting everyone's savings.
But, and this is a huge but, there was a massive catch. As research from the Fed points out, that long-term stability came with a really nasty side effect. Prices would swing wildly from one year to the next. The system was just too rigid. It was like a straitjacket. It couldn't loosen or tighten the money supply when the economy hit a rough patch, which led to these really jarring jolts of inflation and then deflation. And that rigidity, that was its fatal flaw. The very system that was designed to create stability started to crack and then shatter under the incredible pressures of the 20th century. The whole thing basically unraveled in 3 major steps. First up, the Great Depression. It was 1933. The economy was in a free fall, and to fight this crippling deflation, President Roosevelt had to make a drastic move. He stopped letting regular citizens trade their dollars for gold. Okay, fast forward to after World War II. World leaders get together at a place called Bretton Woods, and they try to build a new system. This time, other countries' currencies were tied to the US dollar, and the dollar was still technically tied to gold, but only for other governments. But even that watered-down version couldn't hold. By 1971, President Nixon, facing all sorts of economic problems, just officially closed the gold window. And that was it. The final link was cut, and the gold standard era was over. So the big question is, which system is actually better? Do we make the right call leaving gold behind? Let's put them head-to-head. The old gold standard era versus the fiat money system we've got today. And luckily for us, we've got some really fantastic research from the Federal Reserve Bank of St. Louis that does just that. It puts the two eras side by side so we can really see how they stack up, especially when it comes to keeping prices stable. And the data shows this really clear trade-off. So get this, under the gold standard, average inflation was super low, barely 1%. But that short-term volatility, it was a wild 3.6%. That means prices were all over the map from year to year.
Now, compare that to our modern fiat era. Yeah, average inflation has been way higher, but that short-term volatility was cut in half. That means more predictable prices day to day.
So here's the bottom line. We basically made a strategic trade. We gave up the gold standard's promise of being stable over, like, 100 years for a system that gives us more stability and predictability in the short term, month to month, year to year. We essentially swapped one set of economic headaches for another.
Okay, so we made a very conscious choice as a whole global economy to ditch gold for some pretty practical reasons. And yet, that brings us to the final fascinating puzzle. If our official money system cut ties with gold decades ago, why on earth are we still so obsessed with it?
Well, to figure that out, we have to step outside of economics for a minute and look at culture. And this quote, which comes from research about gold's role in India, really nails it. For literally billions of people, gold's value is about so much more than just money.
I mean, just look at all the things it represents. It's a sign of power and status. It's a symbol of purity and good luck. It's what investors run to when the markets get scary. It's seen as a shield against the very inflation our modern money system can cause. And, maybe most importantly, it's an heirloom, a real physical thing you can pass from one generation to the next that holds its value no matter what some government says.
So when it comes right down to it, that's why gold sticks around. Its value isn't based on some government policy. It's rooted in something way deeper. It's tangled up in centuries of culture, tradition, and just plain human emotion. It represents a kind of trust that you just can't print.
So governments went and replaced the gold standard with all this complex economic policy. But for millions and millions of people, the ultimate measure of what something is worth remains pretty simple and shiny. It just goes to show you, we may have left the gold standard, but we can't quite let go of gold.